Welcome to another edition of Bullish on Business. This is your host and Certified Master Coach, John Randall. Look forward to an exciting topic today on Beat Your Competition. You all have it out there. There's a lot of price compression going on, and we have our D2 investment guru, Drew Watson, is going to take you through how he is beating his competition and how you can do the same. We also have a great sponsor for our program today, Principal, who you've seen at some past D2 events. You'll see them at the upcoming D2 Live. They've been a great partner. They have some really great things. They have a short little video, just 2 or 3 minutes. Check it out. A lot of great stuff on there. We also have investment guru Drew Watson's investment update. So hear from him on what he's seeing going on in the world, what he's saying to his clients, and what you can copy and do in your practice and with your clients. And be sure you get registered for D2 Live. This is going to be our best event ever at Dynamic Directions. You get to see the great Dr. Nito Cabane speak at 10 a.m. on Thursday. And D2 Live runs from noon Thursday to noon Friday. So get registered. Go to the D2 website to make that happen. Our spots are filling up, so get in there. It's going to be the best event we've ever had. We look forward to seeing you there. Stay bullish, and we look forward to talking with you soon. Take care.
Good afternoon and good evening, Dynamic Directions Nation. I wanted to go over with you a market update before we get into our webinar that is proudly sponsored by Principal Financial. Well, we've had a lot of activity, mainly to the upside, since our last get-together. And what we've seen in the markets is a little bit of jitters when it comes to North Korea. Also, a little bit of standoffishness when it comes to the Fed. But mainly we've seen growth continue to drive forward and take the market to new highs. If you're using any of the IRG package portfolios, you've probably noticed that value stocks have lagged behind quite a bit when it comes to market performance this year, and that growth has definitely been at the forefront. We're going to explore that and take a little bit of a deeper dive later on as we get into how to beat your competition, specifically T. Rowe Price. But as we get into the factors, we've had 2 pretty large hurricanes hit the U.S. That has taken crude oil prices again to over $50 a barrel. I think as of the date of this taping, we see West Texas Intermediate crude staying above 50, well, down just a little bit, 60 cents today, but we're hanging right around the $50 per barrel level. That's a key indicator. We've been above 50 3 or 4 times now and can't hold it. Unleaded gasoline obviously had a spike due to the hurricanes, and because I bought a pool with a gas heater this weekend, probably natural gas prices will roll off their all-time lows and start heading farther north. That's Murphy's Law. But in looking at other investments, what we've seen is pretty much the emerging markets have been able to shake off the North Korean jitters. The South Korean market has maintained very close to its all-time high, with everything just going across the 39th parallel there in Pyongyang. I think we will see the global markets react if the U.S. continues to ratchet up its rhetoric and become more bellicose in the tone it takes with North Korea. I believe as long as it looks like there's a potential diplomatic negotiation going on, the markets will probably put this on the back burner as an issue moving forward. Today, what's interesting is Orbital ATK, that's a stock that used to be in some of our portfolios, was purchased by, I think, Lockheed. They make rocket motors and other things that you would need for ICBMs. So that stock was up about 20% in the pre-market. But moving on more in general, we've also seen the performance has really been mega cap heavy this year. Mid and small cap indexes hasn't done as well. And we take some stock in looking back for the year. Mainly large cap tech has led the way, along with healthcare. I would look at a note of caution. I think healthcare has been the primary beneficiary of the total lack of anything getting done in Washington, D.C. Healthcare came under fire pretty heavily and had some sell-offs anytime it looked like there might be a cancellation or repeal of the Affordable Care Act, otherwise known as Obamacare. But with nothing appearing to get done, healthcare stocks have settled in and continue to make new highs every day. That, along with the tech-heavy NASDAQ, the usual suspects there are Apple Computer, Amazon, Google, Facebook, Netflix, etc. One thing that we see as well is emerging markets have had a really good year. The North Korea stuff notwithstanding, emerging market equities and funds and indexes have done very, very well. Most of the parts of the globe have China especially has had a very, very good run. So it does appear that global economic activity has continued to move on. I know the biggest fear is inflation worries. So I would say, even with the hurricanes, the North Korea missile launches, the big story since our last call probably has been the 10-year Treasury bill. It fell to below 2.1% since our last get together. I think as the date of this taping, we're just right around 2.2. But what we see is there doesn't really, the market isn't buying any type of inflation story. So we see bond yields continue to get lower as the year has gone on. I think we started the year on the 10-year much higher than where we are now, maybe even 30 to 50 basis points higher. And what that's given us is pretty good returns across all manner of fixed income investments. But the Fed continues to say they're going to tighten. The Bank of Japan, the European Central Bank, they're also looking for ways to gin up inflation in their constituent economies. And what we'll see is that inflation takes hold, certainly higher interest rates. I still am a big believer that the two things you need to have on your Thompson screen is the 10-year Treasury note rate as well as the 90-day Treasury bill rate. And the difference between the two, is probably the best recession predictor that we have at our fingertips. And that's something that's gotten a little bit closer together, obviously, since the end of the year. But still, there's a little bit more than 1% standing between those two indices. What I would think is it's probably not uncommon to think we would get a little bit more volatility as we close down September and get into October 2017. This is the time of year to get a little bit more volatility. People will look and take stock on what's going on also in pre-Christmas to get a gauge of how they feel the economy's doing. Currently, about 8% of all retail sales take place over the internet. Of that 8%, Amazon controls about 45% of the business that's transacted, and they've got a pretty good handle on all that. So as we get into Christmas season, probably after October, we'll be taking stock on ways to deal with it because we do think the retail landscape has changed dramatically in the U.S. Big box stores are having a time struggling, especially department stores, and competing with online competitors. And it's amazing to think all these stores are closing. Once great and hollowed names in retail, such as Sears and Kmart, even Macy's, are shutting down stores at an alarming rate. And you have Nordstrom's that is looking to basically be taken private in an effort to not suffer the beatings of Wall Street. And Kroger, our biggest grocery store chain in Middle America, is down to around $20 a share. So all that's taking place, and Amazon only controls online retailers only control 8% of retail sales. So I think that is definitely going to be easily seen as a part of the economy that is disrupted. And I think it's important to watch those things and take advantage of it. One thing we'll touch on, because the questions have come in quite a bit from clients, is what's going on with Equifax. The Equifax data breach happened probably 2 weeks ago. Approximately 75% of all borrowers in the United States had their financial information, breached or maybe in the hands of nefarious characters. And that's by most estimates. Right now, Encompass, Ameriprise has some stuff up there about what to do, what to recommend to clients. I think one of the things that's really ironic, we get a lot of questions about LifeLock, but I think LifeLock was actually bought by Equifax or one of the other credit reporting bureaus. So It's important that clients understand how their credit works, where they have open credit, where they don't, what they need to close down, do they need to put a freeze on themselves. For retired clients that don't think they'll be borrowing money and can probably operate off maybe one credit card or two at the max, this is an opportune financial planning moment to sit down and have them request a credit bureau report just to see where their open credit is and what they may want to freeze or shut down completely, as well as reaching out to their credit card providers to make sure everything's okay on the home front there. But we'll see you soon in November in Charlotte, and we hope to see D2 Nation there in the Tar Heel State. And until then, have a wonderful, wonderful month.
I am Jessica Bush, Portfolio Manager at Principal, and I'd like to discuss how to help protect your investors from a low volatility, high valuation hangover. As we see the market today, there are two primary risks facing investors. One is a sustained environment of low volatility, and two is high valuations. Volatility year to date has been reducing in a synchronized fashion across key asset classes, the equity markets, fixed income markets, and currency. In this environment, coupled with low interest rates and low inflation, we've seen investors flock to risk assets and really bid risk assets up to very high valuation levels. Now, there's no certainty when valuations or when volatility could revert back to its more mean norm. But what we do know is at very high valuation levels, few asset classes have the cushion necessary to withstand any movement towards reversion to the mean. As an example, the U.S. high yield market is currently trading at 385 basis points spread. In its history, that spread has been higher 80% of the time, or that index has been cheaper 80% of the time. So that's just one example of, in general, what we're seeing are really high valuations across the risk spectrum. Now, at Principal, in our Global Diversified Income Fund, what we have determined is the best path is to focus again on diversification. Specifically, look for ways to reduce exposure to some of the most expensive components of the marketplace. So traditional fixed income and U.S. high yield come up. And add in more non-traditional fixed income or income generating exposure. Some ideas that we'd like in this marketplace include commercial mortgage-backed securities, emerging market debt, and international mid-cap dividend growing stocks. Further, we've looked to reduce our expensive betas within the portfolio and increase our idiosyncratic risk within the portfolio. This is something we've been particularly focused on within U.S. high yield. So essentially, adding more stock-specific, more credit-specific exposures where valuations have more upside relative to some of the more larger, more on-the-run names you might see in some passive ETF or mutual fund vehicles. Third, we want to stay focused on income. Even as the Fed is gradually normalizing its interest rate policy, we believe that rates will remain lower for longer, as the terminal rate at which the Fed stops hiking could be lower than it's been in past cycles, and as such, non-traditional income will continue to be a key component of most portfolios. Finally, we believe we could be on the cusp of a renaissance in active management. At this late stage in the cycle, it could be an opportune time to layer in top-tier active management as you're reducing expensive beta exposure in your portfolio. These are some of the strategies that we have put to work in Global Diversified Income.
Today's topic at hand is how to beat your competition. With the proliferation of no-load funds and everything is always cheaper and the grass is always greener on the other side of the desk, I think it's important for us to keep a very good handle on what our competition is doing. Today's deep dive is going to be on the historic Baltimore, Maryland firm T. Rowe Price. If you thought only crab cakes came out of the Back Bay area there in Baltimore, think again, that's where all these great T. Rowe Price funds come from. One of the items that we've been able to compete directly with T. Rowe Price on is their overlap. Simply stated, it's kind of the East Coast version of American funds, where if you buy one T. Rowe Price fund, you pretty much have bought them all. And depending on which fund you have, you're going to have a Witch's Brew, which is at this point still in the party, perform very well. Very tech-heavy, FANG-heavy positions. Most of the T. Rowe Price equity funds have large positions in Amazon, Apple, Facebook, Priceline, Microsoft, Google, PayPal, etc. One of the things to take note of is this large cap growth overweight. You can find in some of their funds that might be a little bit more value named in name only. I guess that's like Rhino, Republican in name only, Vino, value in name only type funds, and they still have pretty large weighting in that FANG-esque Facebook, Amazon, Apple, Google type stocks. Specifically speaking, the way to attack this is through true diversification. I think especially if you're dealing with wealthier, older clients that are getting close to retirement, they've seen this picture before in the stock market, and most American consumers are not totally comfortable with Wall Street, and they feel like probably a correction is around the corner. Just depending on how studious they've been of previous corrections, I think most clients would feel like, you know what, we've had a pretty good run, we're at all-time highs. Does it make sense to take money off the table? The issue with T. Rowe, and more specifically if you're dealing with T. Rowe on a 401k platform, is a real dearth of quality fixed income products that aren't high yield focused. Also, as I stated, even some of their more value or equity income oriented funds that they have will have a pretty decent amount of the portfolio allocated to really tech heavy names. So this gives you the opportunity to use your Morningstar tool, do a stock overlap, a stock x-ray, look at what the holdings are, and I would go down even to the top 25 to 50 and look at the level of overlap they have on the T. Rowe Price products. This will help you immensely. I've noticed too, even some of their mid-cap fund names are going to have names that are more large cap in behavior in those more mid-cap type funds. Another area obviously to compete with T. Rowe Price on is really what is the all-in cost of investing. Our experience here is most T. Rowe funds that are on 401k platforms are carrying right around somewhere between 1.2 to 1.31 all-in expense ratios. So even though they're no load, it doesn't mean that they are free. And I think it's important to walk your clients through that, even if you need to pull up a statement of additional information online and show there's a lot of trading fees in these T. Rowe Price funds, and as they clear through, that they will definitely create additional expense for the clients holding the funds, along with the normal manager expenses associated with those mutual funds. One thing to note on the competition scale, if you have clients where Fidelity is the provider of the 401k plan, on the self-directed side, they are being very, very, very robust in letting clients know that some of these investments they're choosing are more expensive than what they appear. We've had some CPAs actually come in and feel a little bit alarmed at what some of the cost of the Fidelity products are, other quote-unquote no-load funds. So the word is getting out to the investing public, some of it spurred on by Department of Labor regulations, I'm sure, that there is no such thing as a free lunch, and that some of these no-load type fund families are definitely carrying a higher than normal or higher than zero expense ratios. So when it comes to T. Rowe, focus on what the overlap is within the fund family. What our experience is it's a very, very, right now, tech heavy. So for your clients who are older, wealthier, that have some investment experience, those discussions, they can probably tell you or me a lot of horror stories of how it was to be invested during the .com crash. And I'm not saying that these investments are going to melt down, but it's not crazy to think that at some point Amazon, that's had a 31% run up this year, or Apple at 39%, may have a little bit of a pullback. Facebook is up 49% as we speak. Priceline 25%. So Alibaba 101%. So it's not really unreasonable to think we could get a pullback in these names, and those T. Rowe funds would definitely be hit pretty hard because of their overweight in that position. Hi, this is part 2 on how to get your competition fired. Today we're going to be looking at the wonderful firm called Edward Jones. Many of you may compete with Edward Jones either on the periphery of your business or head on, depending on what type of community you're in. And what we know is we think we have tremendous opportunities in competing directly with Edward Jones and what they're offering clients. This is what we like to call come up to your job and hit you while you're working. And what this is basically is going to break down Edward Jones' flexible plan solutions that they've been marketing as a solution to the DOL fiduciary rule. Specifically, what our research has shown is the client conversation at Jones around the DOL and making changes is basically very one-sided. It is, we don't have a choice, you don't have a choice as the client, and we're going to go from a brokerage account with mutual funds in it to a managed account solution that has a few ETFs and mainly mutual funds. Now, specifically, I think a really good selling opportunity here is why would someone who has paid upfront probably around 4.5 to 5.5% to get into probably American funds and Hartford funds want to move to an account that they're going to pay probably all in around 2% a year? Now, this is a very good question that probably needs to be asked of your prospects and those people that you're marketing to in your top 30 coveted people you want to work with. And in all the research that we've found, both interviewing clients that have ACAT'd over, I think we've hit them for almost 3 million in the last 45 days, as well as what you can kind of read on online sources, is very much it's the same conversation happening in Illinois as it is in Kentucky, as it is in Virginia, and as it is in Texas. And that is, sit down at the table. The government has set up these new rules for the Department of Labor. We're no longer going to be able to offer these brokerage accounts, and you have to make a change. So basically, right there, I think the clients have an opportunity to rethink their whole relational experience with Edward Jones. From a client consultancy standpoint, I think it makes sense, especially to your more experienced and discerning clients that are typically wealthier, that very few things in life there are no choices. And it appears Jones is pitching this as there is no choice. So consider at a very minimum looking at what you could do with an in-kind transfer from a brokerage account to get the assets over and then help them from that point in a financial planning relationship. But also keep in mind, I think your more discerning clients, that conversation right from the jump is going to sound a little bit weird that they have no choice, they have to do this. I think as they talk to their friends and their friends tell them, well, my advisor said we have a couple ways to deal with this, or this is the way my advisors worked altogether. One key component of this, it appears, is that Jones is eliminating in their managed account any individual securities. So if they really want to make sure the client is taken care of from a fee standpoint, and some of these accounts are several $1 million, obviously the clients have the wherewithal to have individual securities in their wrap accounts, but to this point we've not seen any Jones wrap account platform that really has any type of individual security exposure to it at all. They may be out there, we just haven't seen them, and we haven't seen any reports of them, but keep that in mind. So as we move forward, the Jones grid is this, and this comes down from their home office. The first $250, you're going to pay, the client's going to pay 1.35% wrap fee. The next $250, they're going to pay 1.3. The next $500,000, 1.25%, the next $1.5 million, 1%, the next $2.5 million, 80 basis points, and the next $5 million beyond that, they're going to pay 60 basis points. So there again, Jones just texted me and said, please stop, please stop. Basically, on a $1 million account, the client's wrap fee is going to be 1.287%. Then on top of that, with their FX solution, typically your fees from the funds and ETFs are going to run about 67 basis points. So you can see they're going to be very close to 2% all in. And if your total fee experience is less than that, you should be able to compete very, very well on a head-to-head basis. Also, they do have ETFs in these models, but what we found is the ETF investments are somewhere only between maybe 12 to 30% of the total portfolio, and the remaining dollars are in mutual funds. What's interesting is historically American funds and Jones have been joined, hand in glove in working with clients. The newest fund offerings, what we've seen is maybe a couple of American funds, and it's very, very, very rich with MFS and Hartford products in there. There'll be a few other fund families to kind of filter it out, but you're talking maybe 4 fund families, 5 total, and very, very, very high in Hartford and MFS funds. So if you do your homework in that, what you're going to find is a tremendous amount of stock overlap. What we found in a portfolio with about probably 12 or 13 funds in it, most of the stocks are your usual suspects, Microsoft, Philip Morris. What we found here, to name a few, JP Morgan, Wells Fargo, Johnson & Johnson, PNC, Chevron, Apple, Merck, Pfizer, Home Depot, etc. So it's a very large cap offering, and I think we could do something very similar with your models that you have in your discretionary accounts to basically provide the clients a much more transparent, much more active, much more diversified, and less costly option on investing their money from Jones. If you want a copy of the grid, just get with Jacqueline or Ben after the webinar, and we'll keep doing our own digging on Edward Jones. Until then, go out there and hit them while they're working. We'd like to thank our friends at Principal Financial for sponsoring this month's webinar. Specifically, take a look at their Global Diversified Income Fund. I think it's PGDIX on the Thompson system for the institutional share class. Thank you again, Principal. We couldn't do this without you. Have a great month.